Every single day, new money enters the economy. Not just banknotes, mortgage loans, business credit, digital balances. The amount of money in the economy doesn't stay the same. It changes constantly. Yet, ask people where that money comes from, and you'll get completely different answers. Some say the government creates it. Others point to the central bank. Some insist commercial banks simply lend out other people's savings. Others believe money is printed whenever governments need more of it. They can't all be right. And here's why this matters. Until you understand where money comes from, you'll never fully understand inflation, interest rates, economic booms, financial crises, or why your money buys more in some years and less in others. So today's question is simple. Who actually creates money? Money isn't wealth. Before we can investigate where money comes from, we need to question something most of us never think about. Is money actually wealth? At first, the answer seems obvious. People work for money, save money, invest money, and measure success by how much of it they have. But let's try a simple thought experiment. Imagine two countries. The first has productive farms, modern factories, reliable electricity, innovative businesses, skilled engineers, doctors, teachers, workers producing valuable goods and services every single day. The second country has printing presses running day and night, producing endless stacks of fresh banknotes. Which country is actually wealthier? Most people instinctively choose the first, and they're right. Because real wealth isn't measured by how much money exists. It's measured by what an economy can actually produce. Food, homes, medicine, energy, technology, transport, education, the things that improve our lives. Money doesn't create those things. People do. Money simply makes exchanging them easier. Think of money as a concert ticket. Owning the ticket doesn't create the concert. It simply gives you the right to attend it. Money works in much the same way. It represents a claim on the goods and services produced by everyone else. That's an important distinction. Because if money isn't wealth, then creating more money can't automatically create more wealth. If nothing new is being produced, but everyone suddenly has more money to spend, something else has to adjust. We'll come back to that. But first, if money is simply a tool for exchange, why did humanity invent it in the first place? Why money exists? To answer that, we have to go back thousands of years, long before banknotes, long before coins, long before banks. Imagine you're a farmer. You've grown more wheat than your family can eat. You need a new axe, so you visit the village blacksmith. There's just one problem. The blacksmith doesn't need wheat. He needs shoes. Now you have to find a shoemaker who wants wheat, then hope the blacksmith still has an axe when you return. Economists call this barter. People exchanged goods directly. It worked, but only when both people wanted exactly what the other had. As communities grew, that became increasingly inefficient. Trade slowed. Opportunities disappeared. People needed something almost everyone would accept. Over time, different societies found different solutions. Shells, salt, silver, gold. Eventually, governments began minting standardized coins. Trade became easier. Markets expanded. Later came paper money. Originally, many banknotes weren't valuable because of the paper they were printed on. They represented a promise. You could exchange them for a fixed amount of gold or silver. Today, that's no longer how money works. Modern currencies are generally not redeemable for precious metals. Instead, Money has value because people trust it. Trust that someone else will accept it tomorrow. Trust that businesses will continue pricing goods in pounds. Trust that your wages and savings will still function as money next week. Confidence is one of the most valuable assets an economy possesses.
Because once confidence disappears, money quickly loses its purpose. So we've uncovered our first major finding. Money wasn't invented to create wealth. It was invented to make exchanging wealth easier. But that leads us to another question. Who decides how much money exists? Is it really the government?
If you ask people who creates money, the government is probably the most common answer. At first, that sounds reasonable. Governments spend billions of pounds every year. They build roads, fund schools, pay doctors, support the military, provide public services. Surely they're creating all the money. Not quite. In most modern economies, governments are responsible for taxation and public spending. But day-to-day monetary policy is usually handled by a separate institution, the central bank. That distinction matters because governments decide how public money is spent. Central banks influence the conditions under which money is created and circulates throughout the economy. They're different jobs, and confusing them leads to some of the biggest misunderstandings in economics. So perhaps the real answer is the central bank. After all, they print the money. When most people picture money creation, they imagine giant printing presses producing fresh banknotes. It's an image we've all seen, stacks of newly printed cash. But here's something that surprises many people. Physical cash makes up only a small fraction of the money people use every day. Think about the last time you were paid. Your salary probably didn't arrive as an envelope full of notes. It appeared as numbers in your bank account. When you bought groceries, paid your rent, transferred money to a friend, or ordered something online, no physical cash changed hands. Most modern money exists only as digital balances. So if most money isn't printed, where do those digital balances come from? Imagine you apply for a mortgage. The bank reviews your income, your credit history, the value of the property. If your application is approved, the bank doesn't usually unlock a vault filled with someone else's money. Instead, it credits your account with a new deposit. From your perspective, you suddenly have money to buy a house. From the bank's perspective, it has created a new asset, the loan, and a matching liability, the deposit in your account. That deposit becomes spendable money. You transfer it to the seller. The seller deposits it into another bank. The money now circulates throughout the economy. This surprises many people because we've often been told that banks simply take money from savers and lend it to borrowers. Savings are important. Banks need funding. They must manage liquidity, meet capital requirements, follow regulations, control risk. But in the modern banking system, commercial banks also create new deposits when they extend loans. In other words, a large proportion of the money households and businesses use is created through lending. Does that mean banks can create unlimited money? No. Banks operate within strict constraints. They need enough capital, enough liquidity, qualified borrowers, and demand for credit. If people stop borrowing, money creation slows. If banks tighten lending standards, money creation slows. So banks play a major role, but they're not acting alone. That brings us to our next question. If commercial banks create much of the money we use, what exactly does the central bank do? Think of the central bank less as a money factory and more as the institution that shapes the environment in which money is created. It sets policy interest rates, provides reserves to the banking system, conducts open market operations, acts as a lender of last resort during financial crises, and under exceptional circumstances, it may expand the monetary base through large-scale asset purchases. It doesn't decide whether your mortgage application is approved. Your commercial bank does. But the central bank influences how expensive borrowing becomes, how much liquidity exists in the financial system, and how quickly credit can expand. Imagine trying to steer a large ship. Turning the wheel doesn't change direction instantly. There's a delay. The same is true of monetary policy. Changes made today can take months or even longer to fully affect inflation, borrowing, investment, and employment. That's one reason managing an economy is so difficult. The central bank can influence the direction. It can't control every decision made by millions of households and businesses. The economy isn't a machine with a single on and off switch. It's a complex network of human decisions. Putting the pieces together, our investigation began with a simple question. Who creates money? The answer wasn't as straightforward as many people expected. Governments don't create all of it. Central banks don't create all of it. Commercial banks don't create all of it independently either. Modern money emerges from a system involving lending, borrowing, regulation, confidence. Central bank policy, commercial banking, businesses investing, families buying homes, and millions of financial decisions made every single day. Understanding that system changes how we think about money itself. Because money isn't simply printed into existence. It is continuously created and destroyed as loans are made and repaid throughout the economy. And now, we can return to something we discovered earlier. Money isn't wealth. It's a claim on wealth. If the amount of money grows much faster than an economy's ability to produce goods and services over a sustained period, each pound may represent a smaller claim on real output. Over time, that can contribute to a sustained rise in the general price level, inflation. Many economists, particularly those associated with the monetarist tradition, argue that persistent inflation cannot continue without excessive growth in the money supply over the long run. Other economists agree that money matters, but also emphasize productivity, supply shocks, fiscal policy, expectations, and global events in determining how inflation evolves. What most economists agree on is this. A healthy monetary system depends on confidence, responsible institutions, and an economy capable of producing real wealth. Based on the findings, we can reach one conclusion. Money isn't created by a single person or institution. It is created through a modern financial system built on lending, regulation, confidence, and productive economic activity. Understanding where money comes from doesn't just answer one question. It helps explain inflation, interest rates, economic growth, financial crises, and why the value of every pound in your pocket is never fixed. If you enjoyed today's investigation, subscribe to the Economic Lens and join us as we separate the facts from the headlines. Now, I'd like to hear from you. What surprised you most about today's investigation? Leave your answer in the comments. Some of the best questions become future investigations.